Good morning, everyone. Thank you for joining the today's session. Today we are going to discuss about one of the most common questions investor ask is what's going to happen next? Will market rise? Will they fall? Should I invest now or wait? These questions may be natural because the future is uncertain and markets have a way of surprising even the most experienced investor. Perhaps the better question is my portfolio prepared for whatever comes next? That's what we will explore today in our webinar. So let's dive into our first slide. So for many of us today, market feels far more uncertain than it did a few years ago. So every day we are exposed to a constant stream of information. One day it's geopolitical tension, one day it's oil price, then it's interest rates, inflation concerns, and the AI disruptions, or some new market prediction from any expert or opinion. So every headlines makes us urgent. So every headlines feels important. So every headline suggests that investors should do something immediately. So as a result, many of us feels they are navigating through an environment where uncertainty is constantly increasing. But let's pause for a moment and ask ourselves: It's today's world truly more uncertain, or are we simply more aware of uncertainty than ever before? If you look back through history, investors have always faced challenges. There have been wars, recession, financial crises, political uncertainty, inflation shock, and so much. So every generation has had its own reason to worry. So yet, despite all those events, markets have continued to create wealth over a long period of time. So what has changed today is the speed and volume of information. 20 years ago, investors consume news once or twice a day. Today, information reaches every minute. So television, website, social media, some WhatsApp group, podcast. So everyone has an opinion about what happens next. So and often those opinions are completely contradictory. One expert says markets are expensive, and another one says still have a room to run. One predicts a recession, so another predicts a strong growth. So one person say buy and another says sell. So as investors, it's easy to get caught in the cycle because our brains naturally seek certainty. So we want answers, we want clarity, we want someone to tell us exactly what will happen next. But investing doesn't work that way. In reality, some of the biggest markets, even of the last decades, surprised at everyone. So very few predicted COVID. Very few predicted the speed of the recovery. So very few predicted the leadership changes across the sector and asset class. So the future is always been uncertain. So and it always going to be. So that's why for successful investing, it's about eliminating uncertainty. It's about learning to operate despite uncertainty. So because if we wait for perfect clarity before investing, we will be waiting forever. So the objective is to not know exactly what the future look like. It is to build a portfolio that can withstand different possible futures. So that brings us to the important distinction. So not everything that grabs our attention deserves our action. Some things are simply noise, some things are signals. The challenge for investors is knowing the difference. So and before discuss how to build a strong portfolios, we first need to understand one of the common mistakes we make, and that believe that with enough information they can predict the market with certainty. So if you look what prevent investor from achieving good outcomes, because often it's not the market that causes the biggest damage, it's the decision we make during uncertain times. If you look at some of the common investing mistake, first one is predicting a market movements. How many times we heard someone confidently say markets are definitely going to correct from here, or this is just the beginning of some one massive rally. So the reality is nobody consistently knows what market will do over the next few weeks or months. Think about the last few years. We had wars, inflation shocks, tariffs, and so much crisis. No, yet markets continue to surpass both optimist opinion and the pessimist opinion. So the problem with prediction is not that they are always wrong. The problem is that they create overconfidence. When we are overconfident, we make bigger bets than we should. So successful investing don't need to predict every market move. We have to simply participate in our long-term wealth creation. And the second biggest mistake is reacting to market news. This is probably more relevant today than ever. So every morning we wake up to a new information, some news alert, some WhatsApp group message, a YouTube video, yeah, social media post predicting the next crash. So the challenge is that not all information deserves need an action. So but still we often feel compelled to do something. So when market rise sharply, it creates some excitement. So when suddenly market fall, then there will be some fear. So and the both emotion can push us towards the poor decision. So the third thing is timing market entry and exit. This is one of the most expensive mistakes in investing. Many of us wait for the perfect entry point. They say, I will invest after the correction and will wait for more clarity. And they say market looks very expensive right now. Then market falls, they wait for even lower levels. And when market recover, we feel we have missed the opportunity. The same things happens when exiting. So people try to sell before the correction and buy back later. So, but that requires two decisions to be correct: when to get out and also when to get back in. Even most of the professional investors find it very difficult. So, investing is time is usually more important than timing. And the fourth biggest mistake is the chasing the recent winner. So, we all see this happen when small cap outperformed, everyone wants small cap. When gold performs well, suddenly everyone becomes interested in gold. So, as investors, we are naturally attracted to what's working, but by the time something becomes extremely popular, much of the upside may already be behind us. So the market's leader change over time. So what worked exceptionally well in the one cycle may not lead in the next. So instead of chasing yesterday's winner, we should focus on building balanced portfolios that can participate across the different market opportunity. And the fifth thing is seeking certainty in uncertainty. This may be the biggest mistake of all. As human being, we dislike uncertainty. We want clear answers, we want guarantees, we want to know exactly what will happen in next. But investing doesn't give offer that luxury. So nobody knows where market will be the 6 months from now. Nobody knows exactly how interest rates or geopolitical oil prices or trends will evolve. So but that's okay. But because investing is isn't about certainty, it's about preparation. So no one can predict the future with clear certainty. What we can do is create a portfolio designed to adapt across different scenarios, capturing opportunities when market rise and providing stability when conditions becomes uncertain. So we have just discussed how investors often react to headlines, predictions, and uncertainty. Now let's look at what history tell us. When every geopolitical events occur, first our first instinct is often to think this time is different. Market will surely struggle from here. Maybe I should wait before investing. But if we look at history, markets have encountered uncertainty many times before. So in this slide, if you look, I highlighted several major geopolitical events over the last 15 years, from 9/11 attacks, the Iraq War, and the Mumbai attacks, to the Russia-Ukraine conflict, the Israel-Hamas war, and the more recent geopolitical developments. So in the immediate near time, markets can certainly be volatile, but some events are negative returns in the first months. Others are market recover much faster than expected. But what becomes clear is that the long-term outcome was very different from the initial reaction. If you focus on the 1 year and 3 year columns, we can see that markets have historically showed a strong recovery. In fact, as highlighted in the table, Nifty have delivered positive returns in 8 out of 10 cases. So this doesn't mean geopolitical risks don't matter. It's of course do, but it can impact sentiment, some commodity prices, inflation expectations, and short-term volatility. But history suggests that markets tend to adapt, business will adjust, economy will evolve. So investors gradually move from fear back to the fundamentals. So here, if you look, geopolitical events often dominate headlines, but they rarely determine our long-term outcomes. So, so ultimately, what drives the market return is the corporate earnings, economic growth, so the productivity, so the ability of the business to create value. So that's why reacting emotionally to every geopolitical headline can become a bit dangerous. So far we have discussed the two important ideas. First, market will always face uncertainty. Second, trying to predict every market movement or react to every headline is often destructive. So that naturally leads to the first question. If prediction isn't the answer, what is? In our view, resilient portfolios are not built around forecast. They are built around some few principles. So that work across a different market environment, different economic cycle, or different geopolitical events. So that's where the fourth pillar comes in. Think of them as a foundation of your portfolio, designed not just to perform in one environment, but to endure through many. So first is a diversification. So not simply owning many investments, but owning investment that behave differently. Because no one asset class wins all the time. There will be periods when equities outperform, periods when debt provides stability. There will be a period when gold acts as a hedge. So diversification acknowledges simple truth. We don't know in advance which asset class will next, but so instead of making one big bet, we create multiple source of returns. So second thing is a quality focus. When uncertainty rises, quality becomes even more important. So quality business tend to have stronger balance sheets, better cash flows, so stronger competitive advantage and the greater ability to navigate different environments. So the same principle applies across investment. Rather than chasing what's popular today, good portfolio focus on assets that can withstand market cycles because trends can come and goes, but the quality tends to endure for long term. So third one is liquidity. If you liquidity often doesn't get much attention during stock markets, but it becomes incredibly valuable during the periods of uncertainty because it gives stability. It allows investors to meet unexpected needs without disrupting the long-term investments. It also creates the ability to act when opportunity emerges. So some of the best investment opportunities arise during the periods of market stress. So as investors with liquidity often a better position to take advantage of it. So fourth one is rebalancing. So markets don't move in a straight line. So over time, some part of your portfolio grow faster than others. So without rebalancing, portfolios can gradually take on more risk than originally as we plan. So rebalance helps to maintain the discipline level. It also encourages to trim areas that have become oversights and add to the areas that may have become relatively attractive. So in many ways, rebalancing transforms market volatility from a threat into opportunity. We will discuss how that works in the later session. So now we can see everything in much more detail way. First, we will talk about diversification. So many of us assume a portfolio is diversified because it contains multiple funds or stocks, but diversification isn't about the number of holdings. It's about owning assets that behave different across the market conditions. So first misconception is more fund doesn't mean more diversification. We have seen portfolios with 15, 20, sometimes even 25 mutual funds, which looks diversified from outside. But when we look closely, something interesting appears. The same companies keep appearing across multiple funds. So what will happen though? So we added more names, but not necessarily more diversification. In fact, managing 20 funds is often harder than managing 5 to 8 well-selected funds. So more funds can create a lot of confusion and not a diversification. So second misconception is more stocks doesn't mean less REITs. Let's say if you own 20 stocks, but what if 15 of those stocks are influenced by the same sectoral or one economic place, or maybe they are being a financial play or all are in the manufacturing play. If the underlying driver is the same, then the risk is still concentrated. So diversification is about counting volume. It's about making sure one event doesn't hurt everything at the same time. And the third one is different names and same exposure. This happens all the time. So as we own multiple large cap funds or a multiple flexi cap fund, so it looks diversified, but when you open the portfolio, many of the holdings will be look same. So the aims will be different, but the exposure is very similar. And the fourth thing is the portfolio built by headlines. So this is very common. Yeah, a few years ago, someone bought some sectoral fund or some theme. Maybe that theme become very popular. So somebody will recommend in social media, so maybe friends or some YouTube video. So the portfolio the portfolio look less like a strategy, the more like a scrapbook of your market headline. So every investment made sense individually, but together they don't tell a complete story. So a portfolio should be built intentionally based on our goals and our risk appetite, so not accumulated accidentally. So then what does true diversification look like? It starts with having a different asset classes, not because one is always better than another, but because different assets behave differently. So a good portfolio doesn't depend on one asset class getting everything right. Second thing is different return rates. Some investment benefits from earning growth, some generate income, some perform well in different economic environments. So When your return drivers are diversified, your portfolio becomes less dependent on a single outcome. So the third one is different investment styles. So market rewards some different styles at different times. Sometimes large cap, sometimes mid and small, sometimes growth oriented style wins, sometimes value wins. So a diversified portfolio accept that nobody knows the next winner with certainty. And finally, geographic diversification wherever appropriate. So different economics move through different cycles. So having exposure to more than one region can sometimes add another layer of protection. So it's simple. Diversification is not about owning more investment. It is about avoiding dependence on a one single idea. So because when the future is uncertain, so our goal is not to be right about one thing. It's about to avoid being wrong about one thing. So that's what true diversification helps us achieve. So let's move to the second pillar of your portfolio. So it's a quality. So everyone wants quality, but nobody wakes up the morning and says, "I want to buy low quality asset." But in practice, quality often gets ignored when market becomes exciting. So think about what happens during a strong market places. Sector or theme starts performing well or become popular. So returns starts appearing everywhere, as we said. So everyone in social media, our friends, everyone talk about it. So we also thought, should I also have some exposure? The focus slowly shift from quality to the excitement. So that's where the mistakes begin. So the first characteristic of quality investing is strong fundamentals over market excitement. A stock may double because of some sentiment. A sector may rally because of some positive opinions. But eventually, fundamentals is really matter. Revenue growth matter, profitability, cash flow, the good corporate governance, everything matters. So in the short term, markets can be driven by sentiments and emotion, but in the long term, markets are always driven by the business performance. So second one is sustainable business model. When we build portfolios, we are not trying to identify the most exciting company for the next 6 months. We are trying to identify business that can survive and grow through different environments. So think about companies that have remained relevant for decades. They survived economic slowdowns, interest rate cycles, market corrections, competition. But why? Because the business models were very durable. So a good portfolio should be built on assets that can endure uncertainty, not just benefit from favorable conditions. So third one is reasonable valuation. So even a great business can become a poor investment if purchased at the wrong price. Quality is important, but quality at any price is not always sensible. So as investor, we should be willing to ask, am I paying a reasonable price for the future growth? Because expectations matter. When expectations become too optimistic, even a good business can disappoint. So this is why portfolio construction is not just about identifying quality. It's also about balancing quality with valuation decision. And finally, long-term wealth creation over short-term trends. So many market trends look obvious in insight, but while they are happening, it's often difficult to know how long they will continue. That's why resilient investors focus less on identifying the asset, uh, identifying the niche order, and more on owning assets capable of compounding wealth over a long period. So our objective is not to participate in every rally. It is to participate in our long-term wealth creation and goals. So let's move to the next thing, so liquidity. So liquidity is probably one of the least exciting topic in investing. So nobody talking about when markets are hitting new highs. Nobody talks about how much liquidity they have in their portfolio. But when the period of uncertainty, liquidity suddenly becomes very valuable. So in investing, liquidity is like having a seat, but you don't think about every day but when things become difficult, we feel we had something. So the first benefit of liquidity is simple. It help meet our unexpected cash requirements. So life rarely goes exactly according to plan. There may be a business opportunity, a real estate purchase, a family requirement, a large expense. So when the investors who face the least stress are often those who have planned for those possibilities in advance. So because when liquidity is available, so decisions can be made very smoothly, so without disturbing our long-term plan. So second thing is liquidity prevents forced selling during market decline. So this is extremely important. So imagine markets are down 20%. So news channels are negative, investors are nervous, and at the same time, you need cash urgently. Now you are not selling because you want to, you are selling because you have to. And that's usually the worst time to sell, because the market is already declined, the sentiment is weak, valuations may be more attractive, but yet you are forced to exit. So liquidity protects us from finding themselves in the position. It also allow us our long-term investments to remain invested during the difficult periods. So third one is liquidity creates opportunity during market correction. So let's think about how we feel usually behave during market correction. So many of us worried, many of us looking for exit. So very few are looking for opportunity. But some of the best investment opportunity often emerging during the periods of uncertainty. So when valuations become attractive, when sentiments become pessimistic, when quality assets became available at a better and attractive prices. The challenge is that opportunities are only useful if you have a capital available. So liquidity gives us the cushion to act when others are unable to participate. And finally, liquidity provides confidence during the uncertain period. So this a portfolio is not just about returns; it's also about the behavior. When we know they have when we know we have sufficient liquidity available, we feel very less pressure during this volatile periods. We feel very less panic, also less likely to make emotional decisions. So and more likely to stay focused on a long-term goal. So in many cases, liquidity improve our financial flexibility. So let's talk about rebalancing now. So if you look at rebalancing, sounds very simple, but it is one of the most powerful discipline in investing. So let's use the example on the screen. Suppose an investor started with a target allocation of 55% equity, 30% debt, 10% cash, and 5% alternative. At that point, a portfolio was aligned with the investor's goals and risk appetite. But markets don't stand still. So over time, some assets perform better than others. So in this example, so equity are done very well. So as a result, equity exposure has grown to 55 to 65%. Debt have fallen from 32 to 22%, and cash is also fallen from 10 to 7%. So as the investor made any change, no. But as the investor consciously decide to take more risk, no. But yet the portfolio has become significantly riskier. That's what our portfolio drift looks like. So it happens silently. This is where rebalancing becomes important. So rebalancing simply means bringing the portfolio back towards our target location. So in this example, it would mean trimming some equity exposure and reallocating toward debt, cash, or other underweighting assets. So many of us struggle with this because psychologically it feels uncomfortable. Think about it. You are being asked to reduce exposure to the asset that has performed best. So most of us want to do the exact opposite. They want to buy more of what's already gone up. So but rebalancing helps the discipline in our process. It forces to check as our portfolio changed because of my goals, or as it changed because of market movement. So one way to think about rebalance is it helps us systematically sell a little high and buy a little low. So not because we try to predict market, but because we are maintaining the balance we originally wanted. So we have spent a lot of time talking about markets, portfolio diversification, and all. So if you look at most of the investors don't lose money because they lack information. In fact, today we have more information than before. So the real challenge is our behavior. So because even the best portfolio can fall if investor behavior gets in the way. So let's look at a few common investor behavior bias. The first one is a lost aversion. So imagine your portfolio gains 10 lakhs, you are happy. Now imagine your portfolio lose 10 lakhs, the discomfort feels much bigger. So it suggests that losses hurts roughly twice as much as gains feels good. So and this creates a problem. So during a market corrections, investors often become so focused on avoiding further losses than sell at exactly the wrong time. So think back to the March 20. Many of us sold because they couldn't tolerate the volatility. So yet a market recovered much faster than we expected. So the loss wasn't created by the market decline alone. It was locked in by our decision to sell at the wrong time. The second thing is recency bias. This is As humans, we naturally assume with whatever happened recently will continue. If markets have been rising for 2 years, we start believing it will keep rising. If markets have been falling for 6 months, we start believing they will keep falling. So, for example, after a strong rally in a particular segment, we often feel that the segment is the most safest place to put money. So, not because of any fundamentals, because of the recent performance has been strong. So, we end up looking at we end up looking and trying to buy. So unfortunately, market don't work in that way. So third one is confirmation bias. So what do most people do next? They start looking for information that proves they were right. So they look at for the article that supports their view, so experts who agree with their view, so data that confirm the decision. So at the same time, they ignore information that challenges their thinking. So this creates a blind spot in our investing. So as investors, we should actively seek opposing views, because it is not about prove ourselves right. It is to make better decision to enter in the right investment. So fourth one is hate mentality. This one is very common. So we feel comfortable doing what everyone else is doing. So when everyone around us is investing in a particular theme, sector or strategy, it feels safest to join them. After all, if everyone is doing it, how wrong it can be. But investing in street is something interesting. Crowd often become most enthusiastic near the market peak, so and most fearful near when market hits the bottom. So which means following the crowd often leads investors to buy high and sell at low. So this is the reason the crowd provide a comfort, but comfort and investment success are not always the same thing. So next thing is overconfidence. So most of us think they are slightly above average. Unfortunately, that's mathematically impossible. After a few successful investment decision, it's easy to believe that we have a special ability to predict what will happen next. So we started to taking larger bets. We reduce our diversification. We become more confident in our prediction and forecast. So the problem is that markets have a way of humbling everyone. The more successful we become, the more important we need to be very cautious. And the final one is status quo bias. So sometimes investors know something needs to change. Maybe a portfolio has become unbalanced. Maybe a certain holdings no longer fit their objective and goals. Maybe rebalancing is required, but they won't take any action. Reason is because doing nothing feels safer than making a changes. So even when changes are necessary at that point of time. So sometimes in investing, inaction can sometimes be just as costly as wrong action. So over the last few slides, we have discussed about uncertainty, market noise, and investor behavior, quality, and rebalancing and all. So if you look at if there is one thing you have to take into today is building wealth is rarely about finding the next not on hot investment. It's usually about having a process that help you make a good decision consistently over a period of time. So and that's exactly where we come in. So in M2W, I will tell you how we build portfolio. First one is milestone based planning. So most of us focus on returns, but we focus on milestones, because ultimately portfolios are not built to beat any benchmark and all. They are built to fund our real life goals. So whether it's retirements or child's education, creating a passive income, or leaving a legacy, or simply achieving the financial independence. So every investment decision should move you closer to a milestone that matters. When the focus shift from markets movements to the personal milestones, investing becomes much more meaningful. And the second one is safety and discipline over chasing returns. One of the biggest mistakes we make is constantly chasing the highest return. So last year, when the best performing fund, like that we tend to chase. The problem is that today's winners don't always be remains the tomorrow winners. So our approach is different. So rather than asking what's likely to generate the highest return next year, we ask how do we build a portfolio that can survive different market environments. So because protecting capital and maintaining discipline often matter more than chasing every opportunity. The third one is behavioral coaching and conviction building. This may be one of the most underrated aspects of managing wealth. So most of us don't need more information. What they often we need is the perspective. Think about what happens during difficult markets. So headline becomes negative, predictions become extremes, the fear is increasing the market. So and that's exactly when investors are most vulnerable to making lots of emotional decisions. So our role is not just to build portfolios; it is to help investors stay committed to a well thought out plan during periods when emotions are running high. So sometimes the most valuable advice is not what to buy; it's what we not to do. So the fourth thing is review and adjust to milestone. When life changes, goal evolves, a market moves, or when portfolio drift. That's why investing cannot be a one-time activity. It requires periodic review, not because we are trying to predict markets, but because we want to ensure the portfolio remains aligned with our objectives. So as milestones approach, risk profile may change, cash flow requirements may change, your priorities may change, and portfolios also should evolve accordingly. So fifth one is customized mutual fund portfolio using a multi-asset approach. So finally, we believe good portfolio comes from balance, not dependence on a single asset class, not dependence on a single market outcome. So our portfolios are designed using a multi-asset framework that consider growth, stability, flexibility, and our long-term objectives. So our intention is not to build portfolio that perform only in favorable environment. Intention to build portfolios that can navigate a wide range of market conditions. So as we come to the end of today's session, let's bring everything today. We begin by discussing by why today's environment feels uncertain. Uh, and every generation of investors face its own version of uncertainty. So what's different today is simply the volume of information and competing for our attention. So through the session, we have explored an important idea. So successful investing isn't about predicting the next headline. It's about building a portfolio that can withstand different market scenarios. So that's why we discussed diversification, quality, liquidity, rebalancing, and perhaps most importantly, the investor behavior. So what investors should today? So not tomorrow, not after the correction. So today, take a fresh look at your asset allocation, review whether your portfolio still reflect your goals, ask yourself whether you are truly diversified or simply holding many investments. Ensure your portfolio is prepared for different market outcomes, stay disciplined through volatility, and most importantly, remain focused on long-term wealth creation. So because in history, we have shown us something again and again. Markets will always test investors, but patient and disciplined ones are often rewarded for staying throughout the course. So the investors who create a lasting wealth are rarely the ones who make the most prediction. So they are usually the ones who follow a consistent process. So the next times the market become noisy, don't ask what will happen next. Instead, ask ourselves: is my portfolio prepared for what happened next? So thank you for joining us today. So we hope you found the discussion valuable. We would happy to take your questions. If you have any question, kindly put out in the chat box. We'll happy to address. So yeah, thank you for joining. So thank you for attending the session today.